I think the biggest thing that's going on is there's a shift from monetary policy to fiscal. I mean, President Trump was talking about another middle-class tax cut. We've been in almost a decade-long period where global central banks have been really putting more and more liquidity in the system, and that's inflected in October for the first time where money's actually coming out of the system. So that's point one. And one thing Michael and I were talking about beforehand, I was just in Europe, and you think about people talk about Europe being slower growth. What's happened is the stimulus has actually driven unemployment down, and so we're really seeing wages start to pick up in Europe. Germany's record low unemployment, UK the same thing. So you guys have been reporting about margins getting contracted, getting hit, and so I think that's real, and so I think that's going to be with us. So what's it mean for investing? I mean, we've been really talking about this shift from monetary to fiscal, which is short in duration, probably have less growth in your portfolio, grow stocks, and then really we've been trying to buy things. I mean, obviously we're buying for 5 to 10 years and sometimes longer, so really focused on things that have cash flow that are linked to nominal GDP. So infrastructure has been a big area of focus, buying a lot of things around residential construction actually in the U.S. and then some things in Asia that are good cash flowing assets.
And I guess, Henry, one of the points I think you're making here is that money is going to come out of bonds regardless, and therefore we might not get that classic negative relationship between stocks and bonds. If stocks are falling, it's possible bonds might be falling as well. Yeah,
I think this is actually a secular shift, which is from when Alan Greenspan eased during the kind of the emerging market crisis in '98, for the next 20 years, you could actually buy a lot of stocks and lever those up and buy bonds as your defensive mechanism. And when stocks went down, your bonds rallied. That's exactly what a lot of macro funds did, a lot of risk parity funds did. And recently, what we're seeing is stocks are selling off, bonds aren't rallying as much, and so you don't have that safety net. That's actually a retrenchment back to what it was like from the 1800s until 1998, and so we think it's going back there. And if we're right, that's a pretty big deal.
And how much of a dramatic move would you expect on the actual interest rate side? In other words, okay, that's fine if they're inversely correlated or they're no longer inversely correlated, but if yields don't go up very much very fast, maybe it's not a dramatic move. But
yeah, I mean, if you look right now, though, in European bonds and U.S. bonds, they've actually had the 2-year worst performance that we've seen in decades, and because you've been starting from such a low rate. So I think this is a little bit like the late 1960s where rates bottomed and then they started to go up. We actually don't see rates hitting, moving up materially. Our peak rate number is about 350. But the point I'm making is that they've been the shock absorbers in levered funds for the past few years, and that's going away. So, when QE started, if you got long growth stocks and you got long bonds and with long duration, that's all you needed to know. And what we're saying is that's changing.
So what should be the diversification tool?
What should you do? I would try to, everything you guys are talking about is this shift from monetary policy to fiscal. President Trump's doing that. China's talking about a tax cut for the consumers. What is Italy arguing about? They're arguing about fiscal spending. So I would buy assets that are linked to nominal GDP, infrastructure, real estate, things that have cash flow that are shorter in duration where you don't have the risk in terms of principal. I mean, if you think about us, we're about a $200 billion alternative manager. We're owning things for kind of 5 to 10 years with cash flow, and there are lots of things around the world right now that have been sold off. I mean, we've been in a world where the market has been narrowing and narrowing and narrowing towards U.S. growth stocks, and there's a lot of money in those right now. And what we're saying is this thesis of kind of buying complexity is the way to go in this market, and that's really from our private equity. Probably 50% of our private equity today is related to some type of corporate carve-out. I mean, you guys were reporting on the Magneti and Morelli transaction that we did with our Calsonic division. Unilever, we bought out a division from them. Airbus, defense business. Those are the type of things where, at least from our vantage point, there's real value for our LPs.